Okay, so we've got 4 minutes each. We'll try and be short and sweet. So I'm talking about the capital markets, which could be the easiest talk topic at the entire conference. And that's a sign of how good it is. I haven't put up anything that's under $5 million in a raising, because once I do that, it makes no sense at all. It's a complete wash of cash. So in a perfect world, we just have little pictures of quacking ducks or some sort of money falling from the sky in some kind of clip art, but I'm not allowed to use that anymore. It's been great, is the short version. There is money everywhere. When you do a placement, White Rock, $1.5 million placement, got a second tranche for a few million, you kick off the SPP, underwritten for 1.5, subscribed for 10 million. That's the story of the last few months for pretty much everybody. Everything is massively oversubscribed. De Grey's today, 100 million, oversubscribed. It's a wonderful market for everybody from a capital markets perspective. Gold is fabulous. Mixed metals, nickel, copper, all good too. Those are just the big ones from the start of the period there. We thought last week with the Dow having a bit of a hit, we might start to see the beginning of the end, but we put ourselves back up, and fingers crossed we continue for quite a bit longer. So how's the regulatory relief played into that? Hasn't done what we wanted really for resources companies. So the COVID stuff that came in basically means everyone got an extra 10%. The resource companies mostly already had the extra 10 under 7.1A. It did mean you could do that at any price, but because the resource companies' prices held up, wasn't such a boon for us. The removal of the 1-for-1 ratio cap, again, not really a problem for resources companies. They have let you do the extra SPP and without the pricing restriction, and that's been handy if you already did one before all of this happened and you wanted to do another. There are some sort of hairs attached to the regulatory relief. So the particularly helpful parts for us, I think, are the less publicised ones, which is anyone for a raising can use the 4-day halt. If you do a placement, you've ended up going to the States, maybe the days didn't work out, that's been pretty handy. And also the fact that if you were maybe looking at running into problems from an operational perspective and you didn't have enough going on, ASX has been pretty good about giving you an extension in that explorer end of the market. The parts that this hasn't worked for the resources companies also include the fact that if you do a placement, even though it's not in the official guidance when all this started, to be able to use the waiver, you basically have to go to your existing institutional shareholders in proportion. And the reality is that if you're a company making a strategic decision and you want a cornerstone, a new entity to help you lift your business, build your project, that's not really going to work for you. And you might not want to do the follow-on SPP and rights issue that's required under the waiver. This is a breakdown of how the structures have been used. And you can see that while there's a lot of placements and follow-on SPPs and rights issues, for resources companies it's the placement that's still the winner. And that's because what is underlying all of this is that it's actually a tale of two cities. You've got the Perth resources companies and then you've got the rest of the ASX listed market. And the reason why they're being treated differently is because in that market, the retail money is coming in and the institutional money is coming out. So it's the people sitting at home during COVID with their JobKeeper, JobSeeker that are going into those companies that are not resources companies. And so the SPP and the rights issue in particular have been very big for them, for these to be able to be successful. Whereas the institutional money is coming into the resources companies, and so the placement is still that cornerstone piece. And it's almost a revisit when the retail wash of cash comes in later. And that's been the struggle for the resources companies, that you set it up as a placement, you want your key institutions to come in, maybe you want some new cornerstones, and then your retail wash of cash has been much greater than you'd anticipated. And as for why the institutions are in the resources stock, my guess is as good as yours, right? And maybe it's a Buffett hedge against the whole market. And if so, hopefully that'll last even longer. You can see there the different breakdowns between the types of structures that have been used. The other thing that has made it really hard to use the COVID waiver for resources companies is that when it first came out, you could use it for anything, and ASX copped a lot of flack because a couple of people straight off the bat built some war chests, and that's not what they'd mentally envisaged it to be used for. And because of that, it now means that you had to use it for COVID purposes, and you basically have to apply to be able to use the automatic waiver. When they first decided that, they were pretty harsh on who was actually COVID affected. Couldn't use it for exploration, couldn't use it for anything long dated because it wasn't urgent enough. You had to really fight for things even that if you thought they were primarily COVID related, your mind's in suspension because you can't access the site. It was a bit of a battle. They've eased up a bit on that now, but you still won't be able to use those funds for things like exploration or an acquisition. So where to next? Resource companies haven't had to use too much of that regulatory relief. There's been heaps of cash in terms of the raisings. They're all going well. The golden markets are still moving well. There was a bit of a worry last week, but we're hoping it's all going to continue. Commodity prices are still good. The US election and the uncertainty around that should help gold, at least until the actual election. You do have to watch out for that waiver, but we are expecting that as the JobKeeper, JobSeeker hits those companies which are more mining services based, those people who are still producing, you are going to see a bit more of an uptick in people who are using the actual technical waiver and relying on that more properly, especially if they're big enough that they didn't have the 7.1A extra capacity from the start. The other thing I'd say here is that if you look at the underwriting agreements just over the period, they started off basically saying there's an out for COVID. And if you track them through, and we've done some examples there on the slides, we've gotten to the point now where the underwriters are actually pretty comfortable with the shape of the COVID risk from a market perspective. And you'll often see that it's actually carved out, so there's no out for COVID in most of the deals that we're seeing now from an underwriting perspective, which is pretty good for us. If you're an issuer, you should be pushing back so that you don't have outs for escalations of that in your documents anymore. And so what are the takeaways from an ECM perspective? I'd say there's 3 tips. One of those is that a lot of this money is JobKeeper, JobSeeker retail money when you do hit retail, and it's not real money, right? And so when those people realise that they don't have jobs and they want it back, if someone has seriously stuffed up their disclosure when they raise that money, you're probably more at risk than you are in a more sturdy market where those funds are coming from typical retail investors. The second thing I would say is that where you're doing institutional placements and you want the possibility of upsizing your retail component, whether it's through the underwriting, through the SPP, through the rights offer, you need to make sure your placees are completely comfortable with what you're going to do. Otherwise, at the end of the offer, you'll have more money than you ever expected, but a very grumpy placement book. And the third tip, which is one we give everyone, is we've all been here before and we know how it ends, so let's feed the ducks while they're quacking. Justin's going to talk about M&A and how the cross-holding of institutional shareholders has potentially damaged that potential.
Thanks, Sarah. And thanks, RIU, for giving us the chance to speak. Well, ECM might be sort of all good news. M&A, there's good news and there's bad news, so let's get the bad news out of the way first. Getting M&A deals done in this environment is difficult. Deal pauses and terminations are pretty routine. The FIRB rules, the FIRB net has been tightened, and that's really starting to strangle cross-border M&A. On the upside, some sectors have been busy. We've seen a lot of gold deals, we've seen base metals deals in recent months, so deals can still happen. And fortunately, as we'll see in the resources sector, things are still reasonably active. Distressed businesses, everybody thought major pandemic, we would see a lot of distressed assets coming on the market. The reality is in energy and resources, put aside fossil fuels, slightly different. Generally speaking, balance sheets were fairly robust, and as you've just heard from Sarah, the capital markets are still open for energy and resources companies. So we haven't really seen the wave of distressed M&A that we thought we might, but I have a sneaking suspicion that it's coming. If you are embarking on the M&A journey, then there are some things that you'll need to think about from a contractual perspective, and I'll start to talk about a few of those things shortly. As soon as I figure out how to go forward. Thank you. Where are we in terms of the M&A trends? Actually, you will find that M&A, here we're just looking at public Australian target deals. The trend was actually downwards from 2018 to 19. So the heat was starting to come out of the public M&A market into 2019, partly as a result of the fact that valuations were so stretched it was difficult for acquirers to find value. In the first half of 2020, unsurprisingly, given the pandemic, Deal volumes and deal values across the board have come off significantly, but the bright spot is that in terms of energy and resources transactions, things are still actually quite active. More than half, or almost half of the transactions in the first half of the year were energy and resources transactions, and quite a high deal value, although it should be said that that 35% transaction value there was skewed by one deal, which is actually the Alasa SSR deal, which counts in these figures. Sorry, rolling on. Getting the deal done. The difficulty that we're seeing with clients at the moment is partly a value gap. On the one hand, targets are very unwilling to engage with M&A acquirers because it's difficult for them to get a handle on their own valuation and decide whether or not it's the right environment to deal. On the other side of the ledger, we're seeing acquirers saying, look, there's a lot of money sloshing around in the system, valuations are stretched, and what that's doing is raising the valuation risks inherent in M&A transactions. Timelines are being pushed out. Logistically, it's difficult to get people together. Those key moments in M&A transactions when you need to get people into a room to get through a deadlock are getting harder to pull off. Of course, we here in Western Australia are imprisoned in paradise, if you like. It's actually difficult for us to get in and out of the state. There are exceptions, so unless your name is Clive Palmer, you can at least have a go at applying for an exception. FIFO workers can move in and out subject to a 14-day quarantine. If you've been in New South Wales or Victoria in the last 14 days, though, generally it's difficult to get in. And all of that is just slowing things down in terms of execution. Okay, so if you can actually get people thinking about M&A, one of the big issues, as I said, that we're finding is just this bid-ask spread in M&A transactions, and parties are going to need, we think, to get a little bit more creative in closing that value gap. Early in the pandemic, we saw some deals start to wobble, and the deal doers coming up with some creative structures to try and introduce contingent consideration to the mix. An interesting one down the bottom there that Gilbert and Tobin was involved in, West Australian company Cassini, taken out by Oz, or about to be taken out by Oz. There was a contingent payment there in the event that the acquirer on-sold the project concerned for a value that was higher than that implied by the bid. And that was actually coupled with a spin-out, and we think we will see more spin-outs in the energy and resources sector as a technique to try and close that value gap between bidder and target. Foreign investment, I won't dwell on this. Eddie stole my thunder a little bit this morning. There was a very quick response to the COVID-19 pandemic on the part of the federal government, reducing the FIRB approval threshold, which was up to over $1 billion for free trade countries, down to $0 in March 2020. There's another round of changes coming with effect from 1 January 2021 for so-called sensitive national security businesses. You might be thinking, what has that got to do with resources? Well, potentially quite a lot. For example, strategic minerals, whether they be lithium rare earths, specialty minerals, they're all going to be bundled into this concept of strategic minerals. So if you're in that space, just bear in mind, if you're dealing with foreign acquirers or foreign joint venture parties, it's going to be difficult. What that does mean is that if you're a domestic acquirer, you have got a strategic advantage in this market. Due diligence, as we've said, just the logistics of due diligence are proving challenging. We've seen some interesting technology responses by bidders, people walking around with GoPros on helmets to do site visits. We're going to see more of that technology come into play, and a greater focus on some of those items that we have listed there. I'll quickly gloss over material adverse change clauses and conduct of business provisions. Suffice to say that if you are inking these deals, you'll need to pay more attention to things like material adverse change clauses, conduct of business provisions. These are things that are there to generally protect the bidder or the buyer. So if you're acting for a seller, you're going to need to make sure that you preserve yourself enough flexibility to deal with COVID-19 emergencies as they may arise. And likewise, reps and warranties. All those reps and warranties that you used to be able to easily give about the nature and conduct of your business, now you're going to have to exercise extreme caution in dealing with COVID-19. So if there's a few takeouts from me, it's that M&A is difficult. Things have been slowing down. Logistics are difficult, but deals are happening. Deals are happening in energy and resources. If you're a domestic acquirer, you have a competitive advantage. Most importantly, if it's difficult and you need to get it done, give us a call at Gilbert and Tobin. We'll make it happen for you. Thank you.
Thanks, Justin.
Thanks, Chrissy, and thanks to RIU. Isn't it great to be back and talking about resource stocks that are going up for a change, which is, it's always good. But yeah, I suppose today we're going to talk about the Ta Quan nickel project in northern Vietnam and how at Blackstone we're positioned to feed what is going to be a growing demand for, we believe, green nickel, which is for the lithium-ion battery industry. And I'll talk to you about what green nickel really means today. So we've got an international portfolio of battery and precious metals projects across the globe. We started in Western Australia as nickel and gold explorers out the back of Kalgoorlie, as most juniors start their sort of journey, and then we looked for cobalt in the Goldbridge project in British Columbia. We're still really interested in that project, so that's number 2 there on the chart. That's a district scale opportunity. We're seeking joint venture partners. We think it's much bigger than a junior mining company can handle. So we're talking to some of the biggest mining companies in the world on that asset. We're still exploring out at the back of Kalgoorlie with the Silverson South project as well, and we continue to look for gold and nickel sulfides out there. But today it's all about the Ta Quan nickel sulfide district in northern Vietnam. We have an existing and established mine that's under care and maintenance. The previous owners sunk $136 million into the capital infrastructure, which gives us a great platform to, we believe, build a growing nickel mining company. Really important slide for everyone when you're investing in mining stocks. I used to analyse mining stocks for a living. This is probably the most important slide. You need to understand who your management team is, and I've got one of the better board and directors in the market, Hamish Halliday, Steve Parsons. Steve's he's on fire at the moment. He's taken Bellevue from, I think, 2 cents to $1 or something ridiculous. He's doing it again with Orteco, and there's a number of other companies that Steve's having a lot of success with. But Hamish and Steve have done this for 20 years, so great mentors for me, and yeah, hopefully I can one day be as good as those two. We've got a very strong I suppose, technical board and some really strong management in the background. Steve Enor is the project manager. He's the metallurgist that we bought the mine off, and he's been in country for 10 years. He's currently running the show over there in Vietnam, so he's going to help me restart the mine. Just on the capital structure, we just raised $21 million. We brought in Fidelity. Fidelity is one of the biggest institutional investors in the world, and we're very happy to bring them on as a major shareholder. Board and management, you can see there, 14%. That's really important that you've got skin in the game from the board and management team. We've also got EcoPro, and we'll talk about who they are, but that's one of the largest cathode manufacturing companies in the world, and they've brought on Mr. Jung, who's also on the board, their representative. And we've also got Deutsche Balaton out of Germany, been a very supportive shareholder over many years now. So this is why we're here. So we built this relationship with the Korean battery end users. We went looking for cobalt in Canada, and they said, by the way, we're reducing the cobalt and we're increasing the nickel. So they're moving away from the initial battery was a 1:1:1 ratio of nickel manganese to cobalt in the cathode, and now they're moving to an 8 times nickel to 1 times cobalt and 1 times manganese. So 40% of the cost of the cathode is in nickel and cobalt, and nickel obviously being cheaper than cobalt and more easily accessible than cobalt, which is accessed out of the DRC Congo. There's been an engineering shift towards high nickel cathode. So one thing that we will talk about is green nickel. So Elon Musk came out the other day and said he will give a giant contract for a long period of time if you mine nickel efficiently in an environmentally sensitive way. And we believe we've got one of those projects that will be considered green nickel. We have renewable hydro power we're already plugged into. But it's important to know there's two types of nickel. There's class 1 nickel and class 2 nickel. Class 2 nickel, unfortunately, is not suitable for batteries, and class 1 nickel is the most difficult nickel to explore and develop. So it's particularly of the type sulfide, so you'll need to be looking for sulfide nickel, or you want to be building a HPAL plant, which is unfortunately costs about $1 billion. So we're not in the game of building billion-dollar projects. We're in the game of finding nickel sulfide for the class 1 nickel, which goes into the battery. So you can see the charts there. Class 1 nickel, not much around, a lot of demand coming from the batteries. Class 2 nickel, plenty of it, and not going to be suitable for the batteries. But most, in particular, we need to be looking for class 1 nickel, but also green nickel. So this is EcoPro. So it's the largest cathode manufacturer in South Korea, second largest in the world. So you can see there, two of their customers, Samsung and SK Innovation. So through our partnership with EcoPro, we are already connected to some of the biggest battery manufacturers in the world. EcoPro came in the COVID dip. Unfortunately, it was very difficult for us to access capital. They came in and paid a 62% premium to market, and they paid 17 cents. At the time, the market was very difficult. They now own around 12 to 13% of the company and a very supportive partner and very focused on building a downstream processing facility with EcoPro in northern Vietnam. This is what we're trying to achieve. So we're going to use the existing concentrator. We've drilled out the first ore body, which is the Ban Phuc ore body. We've got a large disseminated ore body, very similar to the Mount Keith nickel mine, which is in Western Australia, one of Western Australia's best nickel mines. We've got the hydro power plant down the road, so we've got very low power costs, but it makes for renewable power, which is going to drive this green nickel for us. We're going to take the concentrate and we're going to convert it into the nickel sulfate form, which is for the lithium-ion battery, and we're going to do that with our partner EcoPro. Down the road, LG are looking to build a $2 billion lithium-ion battery plant in Haiphong, which is the port city nearby the mine. So we're 6 hours west of Hanoi, and we're in probably one of the most emerging or biggest growth stories happening today in Southeast Asia is happening in northern Vietnam. So we've got a particular type of geology. It's the magmatic nickel sulfide, so very similar to what we see in the Fraser Range and Chalice's Julimar. Also the same age setting as the Norilsk district in Russia. We've got the same structural setting as Jinchuan. Jinchuan's one of the largest magmatic nickel sulfide districts just to the north of us in China. So it's a particular type of geology that creates and produces or allows for the finding of some of the biggest nickel sulfide mines in the world. So you can see here, we've gone and drilled out this first ore body. It's right next to the existing concentrator. So we've got the existing concentrator, we've got $136 million of infrastructure, and we've gone and drilled out the first ore body, and we're very close to our maiden resource in the coming weeks. As we were drilling out this ore body, we discovered this high-grade zone. It's called the King Cobra Discovery Zone. So you can see that we just need to keep chasing that down and try and hopefully find the source of the mineralisation, and we continue to drill out this King Cobra Discovery Zone as we speak. So some of these holes won't be in the maiden resource. We had to put a line in the sand and say, okay, everything up to that, about the point of the COVID situation was where everything that will go into the maiden resource. Some of these holes will be in an upgraded resource later in the year. So that's the Ban Phuc. So Ban Phuc is right next to the concentrator, very centrally located. We're now moving out to Ban Chang. Ban Chang is our first of 25 massive sulfide vein targets. Massive sulfide is a higher grade type, more usually for underground mining. The Ban Phuc, which we just looked at, is most likely going to be a very large open pit mine like Mount Keith in Western Australia. So this is what it looks like over at Ban Chang. We're hitting massive sulfide with every hole, and it looks like it's a massive sulfide system. You can see there we've got plenty of shiny rocks, and that's the sort of thing that gets the investors excited. So hole 1, you can see hit some good grades around 2 to 3% nickel, 1 to 2% copper. We've got very strong platinum, palladium and gold credits. And then we stepped out 1 kilometre and we hit the same stuff again. So this is a target. It's about 2 kilometres strike. Most likely looks more like an underground scenario. And we just continue to drill out Ban Chang with 3 drill rigs as we speak. As we drilled it out, we were sort of looking for something we thought was fairly narrow, and then we've got these big broad zones up to 21 metres. So we've got these sort of veining within a broader disseminated zone. So it's looking like it could be potentially a more bulk underground or even open pit scenario at Ban Chang. As we were using our geophysics team, so we've bought our own electromagnetic equipment, we've trained up the local geophysicists, and we continued to do the geophysics out to the east of Ban Chang, and then we came through with the trenching, and we found further massive sulfide or sulfide targets. So this is what we're calling a blind discovery, because of those 25 targets, they're all outcropping targets. The previous owners didn't use the modern geophysics, and the modern geophysics, which we've trained up the local geophysicists, is making blind discoveries as well. This is our third target, or the second of our massive sulfide vein targets. We're drilling Tarkung at the moment. You can see we've got the EM plate on the edge of the mag feature. So the mag is indicating ultramafic. There's a good chance we've got a large disseminated system with some massive sulfide associated. This is 2 of the 25 targets. So we're just systematically moving through this belt, and will take us 12 to 18 months to unlock this nickel sulfide district. But this is what it's all about. This is why we went there looking with the Koreans. We went there looking to build a downstream processing facility to convert the nickel concentrate to the downstream product, which is the nickel sulfate for the lithium-ion battery industry. So through our relationship with EcoPro, we'll now look to build what is the downstream processing to convert the nickel concentrate to the downstream product, which is the nickel sulfate. So most of our nickel peers, they sell their concentrate to a BHP or a Glencore, and they get a payability of the nickel price, which is actually a discount to nickel metal. Our final product will be a nickel sulfate, which trades at a significant premium to the nickel metal price because of the demand coming from the lithium-ion battery industry. So well positioned with our partner EcoPro to build this in northern Vietnam. We will build it on the renewable hydro power. We will use the modern techniques. We'll build this to a world-class and an Australian standard. Couple of key announcements coming: maiden resource scoping study, further studies next year, then restarting the mine in 2022, restarting and building that downstream processing facility in 2022 to deliver into the lithium-ion battery industry in 2023. Just in summary, we've got a portfolio of battery and precious metals. We've got a maiden resource and scoping study coming in the next few weeks. We will be showing the market what that downstream processing looks like from a CapEx and OpEx and an NPV perspective. Well funded now with bringing on the $21 million in the last few days. But most importantly, we've got a board and management team that's done this time and time again, and we're really excited to do it for the Blackstone shareholders going forward. Thank you.
Thanks, Chrissy, for the introduction, and welcome everyone to the Corazon Mining Talk. We're going. If you want a copy of this presentation, it's on our website. An extended version of this is anyway, and it's also on the ASX platform, and hard copies by the booth. Right, Corazon, we're a fairly well-traded stock. We get good liquidity at times, 3.25 billion shares on issue, so undoubtedly a restructure of some form would be required in the near future. Cash-wise, we're going okay. We raised about $1.69 million in August for the current exploration program we're doing in Canada. 2 projects. We'd like to be very active on both projects, but it's been a bit hard at the moment with respect to New South Wales. Last year we had the bushfires, and we also committed to a winter drilling program in Canada. And when we finished that work, pretty much COVID restrictions were in place. So we're finding it a hard time to get back to New South Wales. This talk is mainly about Lynn Lake because that's where we've been active, but I just want to give you a bit of a taste of why we think Mount Gilmore is such a great project. This is a regional geology interpreted map over a soil geochemistry image, where that geochemistry image is identifying the basement rocks which we're targeting. That's copper anomalism in soil samples. The wider space soil sampling is 200 metres by 200 metres, and that's done over a 20k strike length. It's absolutely huge anomaly. That the core of it there, oops, go back. The core of it there is about 8 kilometres long and 3 main centres. This is supported by high-grade rock chips from workings, quartz vein structures on the surface, and so no good copper results, supported by cobalt, good cobalt grades, gold, silver, moly. The fingerprint, the geochemical fingerprint, indicates that it's an intrusive related copper-gold system, and it's a very large system by the look of that. Geologically, we've had a lot of trouble accepting that those granites there, this granite here and that granite there, provide the source for this mineralisation. Chemically, they're not quite right, and age-wise, they're not quite right. So it's been a bit of a hurdle for us to get over in attacking this project geologically, I guess you could say. This hasn't been drilled. The only drilling is at Cobalt Ridge to the south there. It's a small, high-grade cobalt sulfide deposit. The rest of the area hasn't been drilled at all. This is a similar kind of geological map. It's tipped on its side, so north is to the east now, and it just helps with the rest of the presentation. Same kind of thing, it's interpreted geology, map geology, sitting on top of a copper geochemical image. What is interesting, and this is new, this is because our senior geologist is a good operator. When he last did the field work, he grabbed a stack of rocks that he couldn't explain in the field, brought them back, and we've been analysing this when we've had time. We've identified a diorite porphyry there, and anyone that knows these systems, these intrusive systems, these porphyries are a very good indicator of you're in the right area. What we want to see is that porphyry to be at least 200 million years older than those granites, and that puts it in this age range where it's to do with arc magmatism, and if that's the case, it's a similar kind of age to the porphyries you see in the Cadia system and the other big copper-gold systems in New South Wales. So this is our priority exploration target. We've got government funding for 2 holes on this. We have to complete those holes before middle of next year. We've done some regional IP work, and this is a cross-section through that IP line that's there. The top one is a chargeability image. So you see there's high chargeability associated with that copper mineralisation there. It's a resistive lower area and a resistive high. The resistive high is probably associated with these granodiorites and the diorite porphyry. And of course, it's on the margin. The diorite porphyry that we mapped is on the margin of that. So it's a very exciting target for us. We just need to be able to get back there. Right, Lynn Lake, old mining centre. It's some very good infrastructure there that's for our benefit, and really it's an easy process to restart mining in these kind of environments. So we've got hydropower, we've got a hospital, airstrip, etc. It's all there. Corazon has 2 main focuses at Lynn Lake. One is the mine area, and we believe that Lynn Lake is a significant low-cost mining opportunity. To that end, what we've been focused on is identifying near-surface tonnages, I guess early start-up tonnages, that will complement our existing resources, which are predominantly underground type resources. Exploration-wise, it's a cracking exploration project. Hasn't been really pulled together since 1976. The whole environment with respect to exploring for nickel sulfides has changed since then. And proof of the pudding is that any company that's drilled in Lynn Lake since mine closure has made discoveries of nickel sulfide deposits. This is what the mining centre looks like in summer. In winter, that's all white, and it's not worth a photo. But this is the main plug, the A plug, where multiple nickel sulfide deposits are up through there, and this is a satellite plug, the L plug, where the high-grade L mine is. You can see also these red polygons sitting through here. They're VMSs, volcanogenic massive sulfide deposits. Copper, zinc, lead, they're all drill defined. There's even a high-grade one in the middle of the intrusion there. That's a pure sphalerite deposit sitting, never been mined, it's just sitting in there. So this is a very fertile area for a lot of different metals. Resources, we've got about 16.3 million tonnes at a 0.5 cutoff. And to give you some idea of the scalability of these disseminated deposits, if we lower that cutoff from 0.5 to 0.4, our resource would go to somewhere up north of 40 million tonnes. I can give you some idea. talking about Mount Keith before, I think their cut-off for their open pit mine is about 0.18, 0.2% nickel recovered. So our resource cut-off is well above those kind of criteria. Just a geological interpretation of the mine area. We've been, before Christmas and after Christmas, we were focused on doing drilling around a couple of the deposits up there, and we had some success. What we're chasing here was the near-surface extensions of underground mines where surface infrastructure prevented mining at surface. So there's remnant tonnages sitting there. And some of the grades we got, this is quite unexpected, some of the grades we got were exceptional, 37.8 metres at 1.68% nickel. Inside that there was a 22 metre intercept at 2.3, and there's another 37 metre intercept there as well. So this is really unexpected. We undoubtedly we will identify near surface tonnages, and that's only two of the deposits. If I go to a long section through from the L plug to the south to the C deposit to the north, that's what it looks like. Our resources are those purple patches there. They're mineralised envelopes, and inside that we categorise our resources. Where we've been drilling is up to the north there, on top of the A and the E, but you can see there's potential all the way along that belt for surface mineralisation. And we believe we have the opportunity to identify 2 to 4 years mine life in open pittable material before we need to go underground on these deeper resources. It's prospective still. No, despite being discovered for more than 80 years and explored for more than 80 years and mined for a quarter of a century, as I said before, companies that actually drill holes in this mining centre have found deposits. Western area in 2008 found the Disco deposit. Corazon, very early on, we found the El Deeps deposit. Great deposit. Very difficult to drill from surface. We're drilling 800 kilometre deep holes to hit this thing. It's open to all directions. We just think it's better to be attacked from underground. And so undoubtedly when mining does restart, this will be a major exploration push in this direction. Standing back a bit, we believe we've got the best of the exploration ground in the region, identified all the plugs and acquired them or purchased them. I guess historically, nickel was first found at Ralph Lake, which is this one here. They found disseminated sulphide. They kind of then prospected it around there, and they found the A deposit with outcrop massive sulphide. That was in 1941, and since then it's been continuously explored. The L deposit, high-grade L deposit, discovered from ground magnetics. The ground magnetics showed an anomaly. They went out there, identified some disseminated sulphide, drilled the hole, 183 metres at 4.7% nickel, a great find. And it's underneath that, where the old timers had already drilled, that we found this, the L Deeps. More recently, Corazon's been focused on the Fraser Lake complex. We see that as a sister plug to the A plug. There's a lot of sulphide down there, a lot of magmatic sulphide floating around the system. We've done some drilling. We haven't nailed the massive sulphide, but 22 metres at 0.7% nickel, that's not out of place beside some of these major deposits in the mining centre. So we know we're close, and we're just really been lacking that ability to nail the massive sulphide. And there's a number of reasons for it. It's a difficult country to explore. You can see it's a lot of swamp, muskeg and lake. That's us building a drill pad about a month ago, trying to drill beside a swamp. And if it's not like that, it's covered in ice and snow. The big issue with Lynn Lake is geophysics is critical to looking undercover, but the main go-to tool for nickel sulphide exploration is EM. It just doesn't work in Lynn Lake. There's too much conductive cover with these swamps and lakes. We've got a lot of VMSs caught in the system, sulfidic sediments, and that sucks the juice out of your EM procedure, and you just can't see a depth and you can't identify massive sulphides. Just recently, I said at the tail end of an announcement that we're trying a new survey called Mobile MT. This has probably been at least 12 years in development. Some of you probably know the early MT surveys and the way that worked. MT stands for magnetotellurics. It does identify nickel sulphides. We believe that it's going to be near on a direct detection method for massive sulphides, we hope. It can see down to about 1 kilometre. We've trialled it over the mining centre. We have seen the conductive zones that we know about. We've just finished the survey and we're pulling it all together. There's a stack of data this thing produces, and it's going to take a while to pull it all apart. Now, this is an aeromagnetic image, and I just want to give you some idea of what we're looking at going forward with the survey we're doing now. Fraser Lake is that thing there. That's where we've been operating. There are drill hits and really in the toe of the Fraser Lake complex through there, and the bulk of the Fraser Lake complex is boring, but this end we're in is really mineralised a lot, so it's where we've been focused. Recently, we announced that we completed drilling, and the drilling identified extensions to the target area at Fraser Lake. And it's kind of, I think we understated it, but what it's done is linked the Fraser Lake complex with this mottryite ultramafic, which are prototypes. And in the mining centre, prototype, they are spatially associated with the best deposits. So this thing's out here, we've drilled in the middle and identified that this whole area links up. Already talking to Canada today, I said, give us something for this conference, what do you see? And they say, things are getting better as we move down into this area with the mobile MT survey we're doing. They're seeing a lot of activity, and they think that really where we have been drilling is on the edge of where we need to be. So that's going to come out in the wash in the next couple of weeks. That's gravity. Gravity sees deeper, but you can see what we're trying to do. We're trying to link this up with the mineralisation here above these deep-seated structures, and that's where we think where the magmas come up from. So that's where we are. I know it's technical, sorry, but it's where we're heading with this project, and we think we're zoning in onto where there could be massive sulphide. Right, drilling. We've got 2 rigs parked up in Lynn Lake at no cost to ourselves. We've got a fly rig which can move around with a helicopter, and we've got a larger rig we can tow around. We were moving towards defining a drill-out program for some of these near-surface resources in the mining centre, but we've had a bit of a win. We'd have to do core drilling, unfortunately, quite expensive, and the short holes, it would cost a fortune. We've just located from a prospector the first 155 surface holes drilled in Lynn Lake. This is a huge win. We can see these plans on maps, but we've never had the data, so we've got the logs, the assay data, everything like that, and we're just about to hand enter them. So that's saved us a lot of money. We believe we can generate resources from that. Mining studies, we're kind of holding off because metallurgical test work is critical, and where we take that metallurgical test work might depend on where we start up the mining operation. So we're kind of pulling back on that a bit and really focusing on exploration and target generating for the next phase of drilling at Lynn Lake. The rest of it's just motherly statements, I think we can do with that. Happy? Okay. Thank you.
You've got 1:30. That's unheard of. Well done. Thank you, Brett. Cheers. Correct, Radanjic.
Thanks, Chrissy. Again, thank you, ladies and gentlemen, for listening to me talk today. It's great here presenting at the first inaugural Resurgence conference, and thank you, Vertical Events, for the efforts you went to make this happen. Well, today I'd like to talk about Venture becoming Australia's next ASX-listed iron ore producer. And also I'd like to talk about how we're going to make Venture a plus $100 million company through delivering exploration success. Disclaimer. A few highlights. The company listed in 2006, we've spent nearly $50 million in Tasmania. We have 3 discoveries there, 2 iron ore, 1 tin tungsten, so we're looking to leverage off that. Currently, one of those assets, the RIU iron ore mine, has begun mining. We're doing a dry screening operations as we speak. Mount Lindsay is a well-advanced EV metal opportunity, being tin, and also critical minerals opportunity in terms of tungsten. So we certainly sit nicely in that space. So we did a BFS back in 2012. So we spent something like 35 of that $45 odd million on that project alone. Very fortunately, Chalice have done an earn-in on a Julimar lookalike in our Southwest project, and I'll talk a bit about that later. Also, we've made 2 new VMS targets have been discovered at our Golden Grove North property, and in amongst that we have 3 high-priority VMS drill targets supported by EM recently completed. And this morning we just announced a new acquisition at Golden Grove. It's located at Yalgoo, but it joins our Golden Grove North tenure. And we've got a fantastic intersection drilled by previous explorers at 22 metres at 0.8 gold, 0.64 copper, 1.3 zinc. So that's basically a free kick, walk up, start to go and drill potentially a new VMS discovery. In addition to that, we're only a stone's throw from Firefly's Melville gold deposit. And we've got a drill rig starting next week at our Coolin project after it's been broken down in the current job. But so lots to get through, so I'll just move on to that, there's a little corporate snapshot. We just completed a raising of $4 million in SPP of 2.5, of which $1 million is oversubscribed. So we had something like a $3.6 million interest. We currently have around about just over $7 million in the bank. So we're well funded to get Riley up and running. The board has been here since 2006. Lots of experience, been through the Mount Lindsay work program previously, and lots of exploration success in previous companies. Now on to Riley. As you'll see from this next photo, Riley is is located here on in the west coast of Tasmania. That red line is the Bitumen Road all the way to the Port of Burnie, 120 kilometres. We have a road access agreement signed. We have a port access agreement signed. We've engaged Cube to do our logistics solution, so we're ready to go. And this is the deposit, all 1.5 metres thick of it, blanket sitting over the landscape. It's sitting at surface. That loose material that's fallen down there, that's what we'll be dry screening that material initially, and underneath it you've got this cemented gravel. So it's more like a quarry. It's a gravel washing processing equipment, so very straightforward indeed. The iron ore project's been around for a while. We started mining this in 2014, but then the iron ore prices came back. So we're very well advanced, granted mining lease. All the other 90% of the equipment was still on hand, so we were very well positioned to recommence this when the iron ore price popped up in 2019. And then since then we've done a mountain of work, and as you can see, I can go through all of those, but the key components are we got an offtake agreement with Prosperity Steel. We redid the feasibility study. Like I said before, we got the road access agreement, the port access agreement, and just recently the board gave us the final investment decision to go ahead and start mining. Today, like I said, dry screening operations have begun. There's a picture of the Caterpillar excavator on site. Cube were awarded the preferred road haulage tenderer status, and like I said before, they dovetailed beautifully into the running the ship loading at the Port of Burnie. The feasibility study done back in August 2019 at $90 US price gave us a $30 million profit, and today obviously our price is now 125, so it's significantly higher than that. So certainly if you, in terms of the project being only 2 years mine life, we're certainly well positioned to capture these higher prices over the next couple of years. And in the meantime, while we're doing our dry screening operations, we're looking to lock down our funding for the wet screening plant. We're looking at around about circa $5.5 to $6 million to get that done. There we go. So next milestones to complete: wet screening plant financing, followed by first haulage. We've already got a few thousand tonnes on the deck from the work we've been doing, and then some 6 weeks after we begin hauling first shipment. So we're probably targeting late next month, and obviously the company has a great opportunity to become move from explorer to producer. So a fantastic outcome for the company. Now moving on to Mount Lindsay. Just very briefly, tin tungsten project, feasibility study completed in 2012. It's a high-grade tin ton resource. It's now, I suppose, tin's now very much being the anode of batteries and EV metal as well. Mount Lindsay is one of the largest tin tungsten deposits in the world, undeveloped and well advanced in terms of permitting. There's a significant amount of tungsten that sits along with the tin. But recently our strategies changed back in 2018 when we decided to have a look at a higher grade version. So instead of having $200 million capex we had on the feasibility study done in 2012, we're now looking at a smaller, higher grade underground operation, looking at reserves, focusing on that 4.7 million tonnes you can see there, and trying to mine that from underground. So looking at more like a capex of 50 million tonnes for a 500,000 tonne per annum plant rather than a 1.75. There's already 83,000 metres of diamond drilling, in addition to the previous 17,000 metres, plus 60% will be the measured and indicated categories. We yield a very high grade tin con, 75%. You can only get up to 79%, so it's a pure product. And at the current prices of 18,000, that's starting to look attractive. The tin prices were up as high as in the low 20s, but certainly there is a good scope for tin to follow nickel into the EV space. So I think there's a good strategies there. I see the market tightening and demand increasing, and certainly the London Metal Exchange wants have a responsibly sourced tin, and half of the world's tin is alluvial production. So if that gets suspended, then we can see a tightening of the market there. But the London Metal, the International Tin Association is also looking at something like an extra 16-17% more demand in tin by 2030. And Mount Lindesay is just not all about mining that initial area that was defined. We've also got some targets there at Big Wilson, which I'll just touch on briefly. You've got 17 metres at 2% tin in the previous discovery. But what we've been just focusing on just recently is a very high grade Renison target, and that sits along strike from Renison Belt, which is essentially only tin mine in Australia. We have an alluvial tin field sitting here, and a recently completed EM survey has a EM target sitting underneath that. So we're pretty excited about drilling that. So we're looking at probably getting there around about Q1 next year to test that and other targets that were generated by the EM campaign. Just moving on to the Southwest project, we were very fortunate to have Chalice recognise the potential of this project to host another Julimar project. So they recently did a $3.7 million joint venture earn-in. They're on the ground now as we speak to earn 70%. And as you can see, this is a map out of their announcement. We've got the same sort of rocks in the system, and more importantly, we've got massive sulphide, but this is the money shot here that was straight out of the Chalice announcement. This shows the Julimar complex, and this is the Tor project that sits in our Southwest project. So we knew that we had a Julimar lookalike, but once Chalice came knocking at our door, then then did a joint venture, we were able to tell the market well and truly we've got a Julimar lookalike. So watch out for this space. Venture can hold its ground at 30% should we run into a major discovery. Golden Grove, which is subject of this morning's announcement. Just a bit of background about it. We picked this up in 2018, where, a long strike from a Golden Grove mine. You can see from the endowment there from 2002, 40 million tonnes at 15% zinc equivalent. The resource today is around about 50 million tonnes, so they've replaced what they've mined well and truly. EMR bought this project back in 2017 for $217 million US. They have tripled the reserves. They've doubled the throughput. This will be the subject of an IPO coming out probably now next year. So we thought that this package of land, being, if you like, under in the shadow of the head frame, was an ideal opportunity for us. There was already historical gold intersections and plenty of rock chips. We went out there, and earlier this year we announced that we found a nice copper and soil anomaly at the Vulcan prospect, which is up here, and around about the same tenor, looks like a mirror image of Gossan Hill, which is about a 15 million tonne VMS discovery, which was the first discovery in the Golden Grove camp. We then had success a couple of months later. Back in April, we announced the Neptune discovery, same stratigraphy, historic shallow drilling next to a salt lake. So we decided to get some squid, what it's called a squid EM survey, to look through that conductive cover. And the results of that was that at Vulcan we'd delineated an EM target sitting underneath a soil anomaly. We also did likewise at Vulcan North, which is sitting here. There's zinc. And like Scuddles, which is a blind discovery, EM found atop of Scuddles here back in 1991. There was also 1979, and then confirmed in 1990 by EM. The zinc is virtually devoid, is not above the surface. So these little snapshots of zinc sitting way above these EM targets is very encouraging indeed. And today we announced this acquisition. So we've picked up this block of land, which sits along strike to Melville, which is the Flying Fireflies discovery, only about 8 kilometres away. There's a cluster of historic mines there, gold mines. But this area here, this new discovery, is where we have this fantastic intersection. And there it is. It's 22 metres, like I said, at 0.8 gold, 0.6 copper and 1.3 zinc. drilled for iron ore and never followed up. And this sits along strike to our Vulcan North and Vulcan West discoveries. So first thing we'll be doing is heading up there to get an EM survey done again. And just briefly, we'll touch on Coolin. Originally pegged as a layered intrusion concept. Fortuitously, we also realised that BHP had already identified this as a gold prospect. BHP was in gold for about 30 seconds in the life of a great company like that, but it found the Tampia discovery here, which of course Explorum owned and then was taken out by Ramelius for $70 million. That's the pit at Tampia, that's the footprint. This is our footprint, very similar, and this is the BHP rock chip in the middle of it. We're going to be drilling the higher grade plus 100 ppb gold anomalies here. This is quite a significant golden soil anomaly. So the drill rig will be there next week, and then it'll march up to Golden Grove North to drill those EM plates. So just in summary, we're excited about going to the next phase from explorer to producer, so that's one aspect of the venture. We've obviously got any profit from RIU iron ores to be injected into building the much longer term iron ore, tin tungsten mine, at Mount Lindsay. In the meantime, Chalice are giving us a free look at another potential Julimar lookalike discovery. The recent EM surveys have identified some exciting targets in the Vulcan area, and certainly now we've got 4 targets with a new acquisition. And like I said previously, we've got the drill rig, and I don't think I'm going to be using that drill rig continuously between Coolin and probably Golden Grove North for the foreseeable future. So you can see there's several mechanisms. We're an explorer and we're a producer at the same time. Thank you.
Thank you.
Thank you. Thank you. Good afternoon. And just for clarity, Diego de la Vega, the Zorro. The Zorro? Zorro.
Pardon?
Do you know the old classic stories, Zorro?
Yeah,
the one.
that De La Vega as well?
Yeah, that was my great old uncle. Just kidding, anyway. But good afternoon, and thanks very much for coming. And it's great seeing faces and presenting in front of people and not in front of my laptop. And so, thank you very much for attending, being here. I'm pleased to be here in Perth, but I also like to say thank you for the viewers that are watching us from overseas and perhaps from Europe as well. Well, I've got close to 20 years by now experience in mining, and I'm really pleased to tell you the story about Anne Gallen. I always say this is a very personal story because I'm the founder of the company. I was in Argentina 3 years ago, and I was driving past talking to my geology manager, and he mentioned there was an opportunity for a little stamp at Hombre Muerto. This changed very quickly for me to assess what was happening at Hombre Muerto. And now there is a story. Now I'm going to tell you where we're at. But I quit my job, sold my car, took my savings and everything that I had, and put it all on the line. Went to Argentina, Catamarca, based myself for 2 months, and I'm putting it all privately to then back to a list. Since then, we've done a lot of work, a ton of work, and it's been fantastic. And we've got a great team in Argentina. We are doing a lot of work. We may be seeing that we're not showing much, but trust me, we are doing a lot of work behind the scenes. I went to bed around 1:30 last night. We are very engaged in what we're doing. So in due course, we'll show our results. In due course, we'll be showing what we made of. But the key things for our company, our project. And what we have is a fantastic project because we have high-grade and low impurities. You don't come across that combination in a lithium brine sector. So when you look at brines, don't think of WA in terms of the grade of spodumene. Just look at milligrams per liter. So the higher of milligrams per liter you have, the better the project. Also, we have low levels of magnesium and sulfate. So those combinations are fantastic for us. Now, we have a low carbon footprint. So if you look at what we have, we're trying to do this in the most simple way. We have a plan to get this through solar evaporation, proven technology, and as a result, we'll have a small footprint of in our carbon footprint. The reason is the NASHAP has done all the crushing and the grinding and the solubility in the brine. So all what we're doing is using what we have, plenty of sun in an area that has a high level of radiation, so evaporation is very efficient, and we're working with it. So carbon footprint is very small, something to remember. Now, in terms of people, as I mentioned, I've got a fantastic team, not only helping and supporting here in Australia, but also on the other side of the world in Chile and Argentina. If I can make what's the difference between Galan and other junior companies in the same space is, as you hear, I've got plenty of mining experience. I'm an analyst, I'm an optimizer, I look commercially at what we have. How can we stretch our dollar further looking for commercial solutions? And I'm not standing still to get the answer, technical answer for what it is. I try to understand and commercially make the most out of it. Also, our team's got a fantastic lithium experience. Our geology manager, 15 years experience, nothing but lithium brines. Our study manager is based in Chile, and he's a Chilean-Australian, Boris, and he's got plenty of mining experience, hands-on studies, and he's also working in Argentina in lithium, and also Daniel. Daniel's got 28 years working experience with SQM, and he's part of our board. So we have a solid team. We have people that understand lithium. We understand lithium brines very well, and we're trying to move forward in a very safe way because we're a small company and we're trying to maximize what we have. Now, we do have access to water in everything that we're trying to do. We are trying to make sure that whatever solution we come with, we have enough water. So for us, the worst case scenario, access to water comes from Candelas, and we can do reverse osmosis. We've done a mass balance. We have probably around 100 years of potential fresh water in our ground on the low-grade stuff that we have in the southern part of Candelas. So the answer is yes. Do we have water for processing? Yes. Do we have to tap from freshwater sources? No. We're tapping from our low-grade brine that is converted, separated into fresh water and enhanced brine that we can later process, so nothing goes to waste. Now, the next thing is, it's all well and true to have high grade and low impurities, but we have already the resource. We can think what we have can have the fundamentals for development, and especially at Hombre Muerto West, and this is where we put in all our efforts today. We find that we have almost 1.4 million tons sitting there that we can think of what to do with it. And I will show you in the presentation where we can get to that. But just as a reference, when the market was hot and Galaxy sold the Sal de Vida to POSCO, they paid $280 million for one of the best chemistry in the world, that is at Hombre Muerto, selling half of Sal de Vida to POSCO. Is it worth it? Probably not today, but if you put forward the clock 3 years, 5 years' time, that will look like an acceptable price. Things are changing, things will change, and they're moving in the right direction. So bear in mind, 2.54 million tons, that was a transaction. We already got close to 2.1, and we have room to keep growing and go beyond that point. So this is a long story. For us, it's a marathon. One of the key messages that I want to say is that we're doing a lot of work, and while the price of lithium is low, and this is a true story, this is something that we can develop. This is something that's got legs, because it's got great, it's got the right people, it's got everything forward. So when things the market turns next year, we'll have a study done, we'll have a pre-feasibility done, we'll be in pole position to start among the first ones in the sector. And we're already getting the attention, by the way, of our funds. We have one of our funds called Thematica, and they're based in Luxembourg. And by not having a PEA, which we're working and we expect to have in the next, in late November or no later than early December, we will have the resolve to say, this is our CapEx, this is our OpEx, this is our NPV, this is our assumptions. And we'll be able to show that we have a competitive project, and that's what we're pushing for. But Thematica put the money before having these results, and the interest is slowly growing. So the world is changing, and we're doing a great work. And lastly, the work that we're doing, the engineering firm that is doing the study is Worley, and it's a Worley Chile team. So they are fantastic. They are very experienced. It's not Worley Australia because they know hard rock. In Chile, they know brines and know very, very well. So a bit more about us, where we are. So we are under what is well known as the lithium triangle. We are in a lithium hub, so we have the Livent Corporation, we have Galaxy Resources, and then we got POSCO. So why all of this is important? So if I say lithium today, you will think of WA, but if I can tell you that the lithium revolution started at Hombre Muerto with Livent, this started with Sony Handycams, and fast forward, and Livent sell most of the production to Panasonic. Panasonic is known to do one of the best batteries in terms of quality in the world, and that battery is sold to Tesla. So on Tesla cars, you already have a bit of Hombre Muerto running through that, and that started in Argentina. It didn't start here, it started there. So I'm not reinventing the wheel on a project that has never produced lithium. This is the real thing. So all what we're doing is developing this methodically, step by step. We will get there, and we'll be delivering on what we say we'll do. So in terms of the chemistry, this is one of the key things in terms of the chemistry. You see grade and impurities, the lithium to magnesium. So the higher the grade, the lower the impurities, the better your product becomes for being developed. And we are in pole position for our project. And if you look at who's coming after us, it's POSCO, Livent, and Galaxy. So we are in a system that we have high grade and low impurities. Now, putting more complexity into this, I'm putting sulfur to lithium and magnesium to lithium. So the closer to zero, the cleaner your product, and now our products are in this cluster. This might all look a bit complicated. I'll be here for the next couple of days. You can ask me any question out of the booth, and I'm happy to answer further questions. But this is a flavor of why this is very important. Now, I mentioned about the carbon footprint. We have a small carbon footprint. This is lithium carbonate production from brine. This is taken from SQM. And when you look at lithium carbonate produced from hard rock, then you can see the carbon footprints becomes bigger. The same goes with the energy consumption. We have plenty of sun that we use to our advantage. In terms of the company, we have 182 million shares, and we are a tightly held company with 27% of the company held under board and management. Top 20 is around 54%. I personally know most of them. Top 50, probably I know half of them. And this is a story that has been sticking with us, mainly with the people that we know for a long time. So what I'm inviting you to is to have a look at what we have, and we are setting up to move forward into the future, but with a strong base, with a strong project, and also with people that have been sticking with us for a while. I understand that lithium is not the flavor of the month, and probably not of the year, but things will change, and when they change, they'll run. A bit about our board. We have Richard, myself, and Daniel is our key man. Chris is very supportive of us. Terry, that you'll see around here in the conference, and Raymond, that came along with me when I started this company privately. Now, where we are located, this is the Hombre Muerto Basin. Just to give you a reference, this is around 45 kilometers long by 45 kilometers in width. It is massive. You know, from here to Fremantle, just to give you an idea, it's 15 kilometers. So it's 3 times the distance from here to Fremantle by the same side of distance. So Perth will fit there, no problems. It takes a long time to cross this place. So we may not look as big, but we have enough to have a project and with a lot of longevity, and explain you why. If you look at the grade that we have, which is one of the highest in Argentina, we have already also a resource of around 1.4 million tons in indicated. If you transform that by half, then we have potentially 700,000 tons of potential resource. Now, Livent is producing 20,000 tons a year. So 700,000 tons of potential reserves divided by what Livent is producing, that's 35 years mine life. That is a long mine life by any sort of means in the mining space. And if you start increasing that production, you know, you still can think of 30, 25 years mine life and, you know, not move the needle on where you are. So this is something that it can be done. And one of the things that we noticed is that we have a small footprint for evaporation. We have good recovery so far, and we have sent the brine to the lab. And one of the biggest things that we did last weekend, we announced, is the brine is already at the lab. We sent that to Chile. Despite COVID-19 restriction, we have our physical brine in a lab, and we expect in Q1 to have the results for the evaporation ponds and then the production of lithium carbonate. Now, in our area, just want to give you an idea. This area here, the dark area, is the area that Orocobre has for the 17,500 thousand tons lithium carbonate per year installed capacity. Now, this all fits already in our ground. So we have enough space today to do what we need to do. Now, in terms of our time frame of where we at, we are going to be delivering our PFS, so our PEA in next quarter. We finalize our PFS in Q2. We're already asking our pilot permit as soon as we finish our PEA, and then we start with our feasibility and pilot plan in Q3 next year for the next 12 months. So we're going to be delivering a lot of stages through our development. Now, in Argentina, things are a bit slow, but we have a strong support from Catamarca. And a reflection of that, we were given drilling permits very quickly. Spoken to them last week, and they've been very supportive. There's a new mine minister, and they've been embracing our ideas and where we want to go. So all of this is work in progress. We have catalysts; they're all happening, and I look forward to updating you guys when we start producing our announcement in the next few months. So watch this space. This may change very soon. Thank you very much.
Yeah, thanks, Chrissy, and you've obviously schooled up on helium, but it's my job here to school a lot of you up, hopefully. So Blue Star Helium, our strategy is just as it says there, to find and develop low-cost but high-grade helium in the USA. I'll just put that down so I can see you all. And we're the only helium pure play on the ASX, which is quite an interesting place to be. And why is that good? Well, helium's a high-price commodity. It's more and more becoming a high-tech commodity, and I'll tell you a little bit more about that on the next slide. Just right now, we're focusing first in southern Colorado in a helium play fairway, which has been proven by historical production from actually pre-World War II last century, from one of the top 3 highest helium grades ever produced in the US. And in that area, we've got 130,000 gross acres located in that proven play fairway, and expecting similar resource grades in our land. We've got a very active quarter coming up with significant news flow over the next little while, really culminating in a low-cost drilling campaign before the end of the year. So, and then with success, perhaps 6 months after that, we could be in helium production. So helium demand. Helium's a high-tech commodity. It's really come into its own over the last decade or so. As Chrissy pointed out, stole my thunder, it can't be made synthetically. It can't actually even be stored effectively long-term above ground. It's inert, it's got very low density, and it's got the lowest boiling point of any known substance, which gives it some really a good set of unique properties, which means it can't be substituted out in many of the high-tech applications that you see here. It's in MRIs, it's critical in semi and superconductors, in rocketry and space exploration. That's a fun one. You'll see we like it because I think we've had 3 pictures of rockets in the first 4 slides. And it also cools the supercomputing servers of the likes of Google and Netflix and Amazon as well. This real explosion of high-tech uses and associated demand over the last decade or so has driven prices up by about 500% over the last 12, 13 years. It compares quite nicely to other sort of mainstream commodities like gold, silver, especially oil and gas and others. Right. So the supply side, 3 things I really want you to take away from this slide. Firstly, historically, you'll see on the top right there that almost all of the supply of helium globally has come from the domestic US. Some 15 years or so ago, market shares started to be taken from the US by a small number of projects in countries with significant geopolitical risk, places like Algeria and Qatar and Russia. So that's resulted in a lot of interest in the US for new domestic supplies. The second thing I'd like you to take away is if you look on the bottom left of the slide here, is the helium resource grade produced in Model Dome, which is our analogue field and central in our land position, is really world class. It's some 10 times that of any significant supply centre globally. And the third thing, and last but not least, we're located right in the middle of the helium supply chain in the US, right within range of the 3 biggest producers that are pointed out on that slide. So focusing in on the US in particular now, you can see on the top right again, you can see the increase in adjudged supply risk in the US starting from 2007 up through to 2016, where now it appears in the same grouping as the rare earth minerals and others there as outliers to the far right of that graph. So the US domestic price is increasing in response to this, as well as to the increasing high-tech demand that we've just talked about, to US $280 per 1,000 cubic feet of helium at the very last auction from the US government strategic reserve. And you can see there the price climb from those auctions there on the bottom right. So Blue Star itself, we're an early mover in a growing trend, particularly in the US, towards helium-centric exploration and production, specifically outside of hydrocarbon areas. And companies like us will generally sell the helium product as a concentrated gas, 98% or more, under a long-term take-or-pay contract with with all the benefits of security of pricing and so on that brings. And happily also, it's sold generally directly at the plant gate, so we merely have to concentrate the gas and sell it to our user at site. No need for any export pipelines or similar. So in this next section, I'll talk about the confidence that we've got at our enterprise prospect. So this is the first prospect that we've had independently assessed in terms of its resource, and the pathway to production for that prospect upon success. So Model Dome, you can see there on the right, this is a cross-section through our historical production analogue Model Dome and our 2 initial prospects, Enterprise and Galileo. And Model Dome produced pre-war last century, produced at around 500,000 standard cubic feet a day of raw gas, which is pretty good production from these kinds of shallow, vertical, very straightforward, very simple wells. And that's proven helium source here for us and charge. It's proven that we've got a really good effective reservoir and a good effective seal trapping the helium over the top. So we've taken that and we've shown or proven that the helium play fairway extends particularly over our prospects Enterprise and Galileo, but also more generally over the area, and I'll show you the rest of our portfolio in a minute. So we've done that with petrophysical analysis of surrounding wells, which have been quite useful for us, as well as a proprietary regional soil gas survey, which has shown high helium anomalies throughout the area. Okay, so the next thing we have to do is drill, and you can see we've our fancy staking flag there in black, in the middle of our Enterprise leases in blue. We've got our Galileo leases there in green, and we're expecting to start drilling later this year. So Enterprise in particular is independently assessed there at 2.3 billion cubic feet of recoverable helium. That's net to us and importantly after royalties. It's very shallow, it's simple to drill, it's pretty standard day-to-day fare for drillers over there. And our proof of concept well here that we're planning for later on in this year will cost us only around US $300,000, which if you do the numbers, which I encourage you to do, it's quite some extraordinary risk-reward equation to be able to spend that on a proof of concept well for potential return of 2.3 billion cubic feet of helium. So upon success here, we're planning a modular style development. We've just been talking about our enterprise prospect, but these modules can be used to any of our other prospects once helium is proven as well. It's one of the benefits of going modular. So all we need to do at site is to concentrate the helium from what we're expecting in the raw gas, around 8%, to about 98% ready for sale. And that's achieved with a pretty simple piece of kit. You can see a picture of it there on the top right. It's called a pressure swing absorption unit. It's readily available in standard sizing over in the US. Excuse me. So a standard size here would be a 2 million cubic feet a day unit. They're relatively small, they're low cost, and they can deliver with an 8% raw gas input. 50 million cubic feet of helium per annum, or in other words, half a BCF over a 10-year contract. These plants, we can mobilise them to site in around 6 months or so and start producing, and we need only around 5 wells to fill these to capacity. So the use of these standard modules has a few benefits for us. It reduces our upfront capital expenditure. If we purchase it, they're also available for rent, which would also give us an extra helping hand. They accelerate, because they're standard, they're already engineered. They accelerate at the time required to first production of helium, and they're quite easily redeployed to subsequent locations. And we can obviously, we'll expand any development to the appropriate size for the prospect by adding multiple modules. So in this final section, I think I'm close to time, I'll talk about bringing forward our other prospects to the same drilling campaign as we've got planned at Enterprise. Obviously give us increased scale, but also increased confidence in getting one or more successful hits from the campaign. So this is our acreage position here. In yellow, you can see our land position, all 130,000 gross acres of it. Now, to key you into the sheer size of what we're talking about here, each one of those squares that you can see is called a township in the US, and they're 6 miles by 6 miles, and you can see the number of those that cover that land position. So the 2.3 BCF at Enterprise and the 3 BCF in total for Enterprise and Galileo, you can see comes from all within those blue and green circles where our Enterprise and Galileo leases are. And you can see the rest of our portfolio with the possible potential that also has. We've got several other, I think 9 other prospects dotted around there that we're working to bring to the same level of maturity as Enterprise and Galileo, and hoping to promote 1 to 3 of them to the drilling campaign as well. So this area is kind of interesting. It's obviously got Model Dome, the historical production in the middle there in green. It's a very prospective area. We see the helium play fairway extending across most of it. And we've got a 2-year head start in terms of our technical work here ahead of any competitors. It's got Model Dome, proven fairway, and we've got basically at least a footprint in every single prospect we've identified here, and we're looking to consolidate the leasing over preferred prospects, building into the drilling program starting next quarter. So we've obviously got Enterprise. We've got a little picture here of a not very impressive orange flag, but it's quite important to us, and some nice flat, easy ground to start drilling on. And our further prospects and leads where, like I said, we're looking to consolidate the leasing there, got some infield surveys planned and adding prospective resources assessments over those as well. So that's all happening in the next quarter or so. In summary, we're the only helium pure play exposure that you can get on the ASX. We're operating in a proven play fairway in Colorado in the US in the middle of the helium supply chain. And we can expect high-grade resources if found in the area that we are. And we've got a low-cost, high-impact drilling program planned for next quarter, so very soon. We're all very excited. Hopefully we can get a number of prospects onto that drilling campaign. Thank you very much.
Thanks, Chrissy, and good afternoon, everyone, and welcome to those joining from afar. Thanks very much to RIU for making this happen. Fantastic event. So I'm delighted to present Attrum Coal to you today. Attrum is developing the world-class Elan hard coking coal project in Alberta, Canada. And I think it presents a rare investment opportunity, so I'm pleased to take you through that today. So let's look at our corporate snapshot. The ticker is ATU. Market cap is just over 150 million. Cash sitting around 15 million at the moment. And major shareholders, we've got Tim Roberts and the Warburton Group sitting at 19%. We've got funds sitting at about 20%, including the likes of Nero, Regal and Perennial, all great supporters of the Attrum story. Probably close to 100 years of coal experience in board and management, so located in Australia, in the US, and our operating team is in Canada. If you look at the market for coking coal today, and really the first thing is to remind that this is coal for steel. This is not coal for power. So the market at the moment is going through something of resurgence. This is high quality coking coal. And really, like iron ore, high quality coking coal is needed for blast furnace efficiency. There's no baseload substitute. So much the same as iron ore, high grade coking coal is extremely necessary for blast furnace productivity. If looking at the coal market today, we're at a historical low point in the cycle. So because of that, the impacts of COVID, because of demand falling away in the first half of 2020, prices have sort of retreated back to around about the 110 to 115 mark. But we do expect a rebound in future in the near term with demand increasing as steel production goes up, we expect in 2021. And really the long-term fundamentals are still there for high-quality coking coal. Really the other key aspect is that there is no or very few high-quality, large-scale coking coal projects coming in to provide that supply. So high-quality sources like Elan will be very much in demand. I want to take you through just the fundamentals of what I said before is a rare opportunity, which is the Elan hard coking coal project. If you look at the map on the right-hand side, these are our tenements. It's one of the largest tenement holdings in this basin, this sedimentary basin in Western Canada. And those points to the left-hand side or to the west, Fording River, Green Hills, Lion Creek and Elkview, are the 4 Teck mines that are currently producing 25 million tonnes of high-quality coking coal at the moment. And just over the border in Alberta, we have in green the Isolation South and the Elan South deposits as a part of the land holding of Attrum. So we've explored probably around about 15 kilometres of a 40-kilometre strike length. So there's still a lot of undiscovered coal, we think, in our tenement holdings. We also, at this point, have 454 million tonnes of total resource, and that's growing by virtue of the fact that we have that strike length. Really importantly for development, we have shallow, thick coal seams, near surface, to allow a low strip ratio. We have tier 1 hard coking coal, so we have very high quality coal, located in this low cost mining region, and most importantly for these types of ventures, we are close to infrastructure with spare capacity. So around about 30 to 40 kilometres to the rail, you can see Coleman and Blairmore, where the rail is to the south, and then that heads west to the Western Canadian ports. To the immediate south of Eland South is Grassy Mountain. And this is the project that Gina purchased in 2019, paid about $900 million for. They're expecting their permitting in the first half of 2021, which will provide a significant catalyst for us as the Eland project. Looking at the geology, looking at the sequence, 4 coal seams, very close to surface. Average thickness of those 4 coal seams cumulative is around about 30 metres, but we do get structural thickening up to about 100 metres. And importantly, as I said, close to surface to allow for a low strip ratio and attractive development costs. If you look at the comparative quality of the Eland project against its peers in the area, this is a low to mid-vol hard coking coal with favourable ash content, and particularly low sulphur and phosphorus, which are elements that are not really welcome in the blast furnace. So what we're seeing is a high rank bituminous coal, analogous to what Teck is producing today. In fact, it's the same coal seams, same coal measure, and when you look at it comparatively in the world market today, ranks very favourably against other coal producers. So as we know, in most commodities, high quality commands a premium. I mentioned before ready transport logistics, around about 30-40 kilometres to rail and out through the Western Canadian ports. So our market will be across generally in Asia, in the US. We're already having discussions with the rail provider and the port providers now to establish the basis for our pre-feasibility study, which we've just commenced. So very important in terms of establishing the development credentials is the availability of that infrastructure and logistics. I mentioned before about that basin scale upside. So we have the Elk Valley complex operated by Teck to the west, which is 25 million tonnes, and we haven't fully explored the potential of the Eland leases. So once we do that, we can escalate from that current 454 million tonnes of high quality coal resource. And again, Grassy Mountain, which is Gina's project, to the immediate south. So we hold a significantly higher land holding or tenement than Gina. We prepared a scoping study and released that in April of 2020, and that was the culmination of several months' work, taking in the project from the resource work, as well as looking at an initial asset configuration and pathway to market. The key physical outcomes from that scoping study, we looked at 2 cases, one 7.5 million tonnes per annum and the other one at 10 million tonnes per annum. At a 60% coal yield to clean coal, that puts us around about 4.5 to 6 million tonnes of clean coal per annum. But we see significant upside in these numbers. One is the strip ratio. This was a combination of the Isolation South and Eland South deposits, whereas we see Isolation South has a significant advantage. The processing yield we think is conservative. In the basin, we see numbers between 60 and 70%. So the current coal test work that we're doing, we expect will validate numbers probably slightly higher than that. And also the total hard coking coal product there. We weren't able to fully report the full value potential of the project because a lot of the deposit was in the inferred category. And in 2020, we've really focused on infill drilling to look at upgrading the classification to measured and indicated. So with that in mind, we think there's real value upside once we fully upgrade the resource into those higher categories. On the right-hand side there, you see that bar chart, you see the comparative strip ratios. So even at around about 4.3 or a product strip ratio of 7.2, we compare very favourably against Grassy Mountain and Tech at about 9 and 11. From a financial perspective, from the scoping study with the two cases, we assumed a realised price of $138 per tonne US. At the moment, as I said, that's sitting around about 115. Long term, over the last decade, has sat around about the $180 mark. So we're sitting sort of in between long term and what we have today. But we think there's certainly strong fundamentals for recovering to that sort of level in the near term. The cash OPEX there at $81 to $84 a tonne US puts us at the lower end of the second cost quartile for seaborne coking coal. Again, we think we can potentially improve on that with the lower strip ratio Isolation South. And also looking at the NPV there, just below $1 billion US, with being able to fully report the value potential from an indicated and measured resource base, we would hope to see that climb over $1 billion in 2020, 2021 from the pre-feasibility study. As mentioned, key upside from the resource drilling, the orange zone there to the north of Isolation South was the inferred zone. So our focus in 2020, 25,000 metres of drilling, combination of RC and large diameter core, has focused on upgrading that orange zone, and we expect to release a resource update in Q4 and are certainly confident to see that upgrade in classification based on the results to date. We also see the potential from processing yield, as I mentioned, currently assuming 60%. For every increase, actually a 5% increase in yield will yield something about $300 million in NPV, so highly sensitive to yield between ROM and clean coal. So the work this year, as I said, is focused on upgrading the resource. We expect to be able to report those favourable results in Q4. So there'll be a good news flow between now and the end of the year in terms of the drilling results as well as the coal quality. The PFS has commenced. We've got a team of an integrated owners team between ourselves and a number of consultants. Many have worked with Grassy Mountain on the neighbouring deposit, so that brings about the opportunity to bring some of that knowledge from Grassy's development to our project, and our target is to have the PFS done by mid-2021. Path to development, around about 2 years for permitting. After the PFS in 2021, we will start the permitting process and aim to be in production by 2024. The social licence to operate, a real focus for us, proactive engagement with local stakeholders, including First Nations and community. And one of the key developments this year, and I think a measure of the Alberta government's focus on stimulating investment, is to remove some of the classifications on land, which actually makes it easier for the ELAN project to get into production in coming years. So we're very happy to have the support of the Alberta government. So just in summary, a rare opportunity in a great jurisdiction in Canada, large-scale resource, near infrastructure, Tier 1 hard coking coal, and a very deep and experienced team to bring it to fruition. Thanks very much.
Thank you, Andrew. Thank you very much.
Right, let's get cracking. So we're a uranium development company with assets in Western Australia and the Northern Territory, soon to be Westralia and another company. country. We've just refreshed our DFS, which has significantly improved the economics of the project, and we have state, federal environmental approvals, and I'll talk about these in a lot more detail, obviously. We have a very good team. We've all built mines before, including BC Iron, and we have a uranium marketing expert over in America, Scott Hyman, who's been working in uranium marketing for 30 years, and he's a real key asset to our company. Our CapEx funding, we often get asked about this. Because uranium is a contracted sales business, it's all hedged. That would mean that we could gear higher and have lower dilution when we're building this project, and that's a really important aspect of this kind of business. And then KPMG has just joined us to help us bring in strategic partners. Uranium is a strategic metal around the world for power, and we're looking forward to working with KPMG on that. So what have we been up to? We just recently announced the DFS refresh. We announced that all of our state government approvals are now done, and that KPMG has joined the partnership process. Coming up, we will be making some announcement on some ore sorting technology that we've done at the Northern Territory project, Alligator River exploration update, and hopefully this year, certainly into next year, we'll be announcing that we've secured uranium contracts and moving towards funding. So we are moving the project towards mining. That is our goal, and it's the best way to build sustainable value for shareholders, is to be in production. So the projects, where are they? Mulga Rock is in Western Australia, 240 km east of Kalgoorlie in the Great Victoria Desert. Unlike Andy's fantastic photograph of British Columbia, this is just very flat and very uninspiring country, but a great place to build a mine. 90 million pound resource, it's one of the largest in Australia, with 42 million pounds in ore reserves. And the DFS has a $605 million Australian NPV at US $55 a pound. I'll talk a bit more about this in detail. The Alligator River project is in Arnhem Land in the Northern Territory. It is a very underexplored area of world-class uranium deposits, including Jabiluka and Ranger. And we have a deposit up there called Angularli, which is a 1.3% uranium project. And we have multiple walk-up targets, which is ideal for a partner who would want to come in and JV with us, and that's something we're working on. So the Mulga Rock project, as I said, out past Kalgoorlie on the Tropicana Haul Road. We've got all of our mining leases. We've got 2 mining areas. We call them Mulga Rock East, Mulga Rock West, and a huge bore field. Sorry about that. I'll just keep talking about this. These deposits are old paleo channels. They're actually loose gravels and sands full of organic material, so that's a typical drill hole there. And you can see the very sharp boundary between the waste and the ore. That's really important for us. We have very good grade control in terms of mining it. The uranium is very simple metallurgically. There's no complex minerals, and this is all free dig, so there's no drilling and blasting required. And how do we know that? Well, we dug a couple of test pits during the DFS, and you can see them in the photograph there. It is free digging, as I said, highly selective. And you can see in the picture on the lower left-hand side, the demarcation between the black ore zone and the overburden. It's really quite simple. So that's one of the test pits that we dug, just showing you how simple it is. Those pits are still open, great geotechnical assets there. And we hope to have a much bigger pit in a not too distant future. That's our plant. Very simple process, acid leach and then resin and pulp. So resin and pulp is no different than carbon and pulp in gold. And what we basically do is wash that white sand out of the ore. We end up with this organic sludge that we then introduce to a sulfuric acid leach. We go into an ion exchange, and then basically we strip the uranium off those resin beads, and then we package it and sell it as yellow cake. It's a really simple process. Very low risk, and we have done proof of concept through test pits and a pilot plant that was done during the DFS. The Alligator River project in the Northern Territory, there are 3 areas in the world that have world-class unconformity style uranium deposits. Kazakhstan, which anyone who is into uranium, remotely interested in uranium will have heard about. The Athabasca Basin, some of the world's largest and richest deposits. And then the Alligator River project, province, which is up in the Northern Territory. Part of it's in Kakadu, obviously off limits, and the other part is in Arnhem Land, which is completely on limits. So this includes some big deposits like Jabiluka, 350 million pounds, and Ranger. So there are some world-class monsters up there, and that's why we're interested in it. This is the Alligator River province. Our projects are in, I think it's green, that color there. being colorblind geologist here. And just to put it into context, this is the same tenement package overlain on the Athabasca Basin. So these blue tenements are Cameco, the biggest uranium company in the world, and that's our tenements sitting in the Athabasca Basin, just to show you the sheer scale of these deposits, 80 kilometers north to south. And the Angularly deposit, which is the one I was speaking about, just sitting in there, and we have several other prospects in that area. The reason we like this is it's very unexplored because of uranium politics in Australia. It's had no modern exploration. The Angularity deposit, I mean, look at the size of it. It's not even 1 million tons, but about 26 million pounds. So it's a really small little nugget. You could literally mine that in about 14 months. So the scoping study that we put out, we showed that you could mine it part-time over a 4-year period and have a 9-year metallurgical plant life, and the OPEX would be on the first quartile of the all-in sustaining cost curve. This is a target-rich environment, ready to drill, and as I'll talk about later on, we're looking for joint venture partners for this particular project right now. I mean, one of the options is you get Mulga Rock up and running, get some cash flow, and then drill it, but we'd like to have 2 phases going. Now, the refresh was just announced. The NPV's gone up by 14% to 605 million Australian, with an IRR of 31%. The capital cost at 393. We've dropped that by $100 million and a payback of 2.4 years. And these are the really important things, the operating costs. The all-in sustaining operating costs for years 1 to 5, because that's when we're into the high-grade material, is $28 a pound. And that's very low in the uranium world. It's competitive with the Kazakh operations, and it does have a long mine life, plus our pipeline of projects makes it really attractive to utilities. These are just some waterfall charts. We'll have this online, and obviously in the chart you can have a look at it in a bit more detail. This is the all-in cost curve for uranium this year, and what I want to show you is this is Trade Tech, who's one of the main price reporters. This is their price for what they think the price needs to be sustainably, about $44 to sustain production without profit, so that would be an all-in sustaining cost. And that's our all-in sustaining cost there. And one thing I really want to highlight here is this is currently what we're burning in the world, 180 million, just over 170 million pounds, and this is what we're currently mining. So there's a massive supply gap. Now, because the uranium that's being burnt in today's reactors was mined 3 or 4 years ago, the supply gap will not manifest until 22, 23, but the utilities will start writing those contracts later this year and early next year. So for uranium, the time really is now. Sensitivities as well, very insensitive to the operating capital costs are very insensitive to changes in costs, and it's moderately sensitive to price and uranium price. And again, have a look at this, come around and have a look in the booth. This is the consensus outlook for uranium, and that's our break-even price. So that is at 36.65. The NPV for the project is 0, so every dollar after that we make money. We would like to get $55 as a weighted average contract price. That'll obviously be a lot of different contracts, probably 10 to 20 at different prices, but 55 is what we're aiming for. At 65, this project's $1 billion, so there are some people who think the price will go that high. In terms of implementing the project, right now we've finished the DFS, going from left to right. The secondary approvals, which are the government environmental management plans, are done. Uranium offtake, we're hoping to secure offtake later half of this year and into next year. If that occurs, we can then move into FID and financing. So this is the key for us, is the uranium offtake, and that's something that we can't control. The U.S. reactors they have their own minds, but we are certainly in front of them all the time, and having Scott in the States to do that, be in their face and remind them of who we are, has really paid dividends, because we had a chat to a utility the other day who referred to the Big Five, and then we're next. So we get a lot of feedback when we put RFPs or requests for proposals in. We know where we sit in the pecking order, and we're very high up in it, so it gives us a lot of confidence we'll move the project forward. From FID to construction is 2 years, and first production we're aiming for the latter half of 23. It's a pretty aggressive timeline, and as I said, make no bones about it, it depends on the uranium offtake contracts. So in terms of what we've been doing, state government approval, we are only one of 4 in WA who now have the environmental approvals and will probably get underway. The other 3 mines being Cameco's Tuma operations and Toro. We have federal EPBC approval, very important. We have all of our tenure, so all of the mining leases that we need for life of mine. We have our Aboriginal Heritage Management Plan. We have state secondary environmental approvals. We are the only one, as I say, in WA to have those, and we need to get our building, our mining, our safety, and our export licenses, and that's basically done at the bureaucratic level. There are no ministerial approvals required for this. We're through that process, and so we are moving towards mining. In terms of our team, most of you would know most of the people on this slide. Cheryl Edwards is our chairman. Tony Chamberlain was our COO and is now on the board. As we didn't move ahead at the end of the DFS, Tony moved on, ironically, to BC Iron, or BCI Minerals. And Julian Tapp, one of our key guys, he does our approvals. He's an absolute wizard at it. Without Julian, we'd certainly be a lot further behind than we currently are. And then Scott Hyman is our guy in the States, 30 years in industry experience. And one thing about the nuclear industry in America, it's a very small industry and no one moves. So he goes and talks to people he worked with 30 years ago. And then Marcel, one of the best CFOs I've ever worked with due respect to the other ones, but very strategic, a great right-hand man to have. And Xavier Moreau, who anyone who has worked in mining in Western Australia would know, very, very knowledgeable uranium geologist, been in Western Australia for a long time. His accent's thicker than mine, but what he doesn't know about uranium isn't worth knowing. And just a bit about the company, we'll skip past that. And then finally, I just want to leave you with this commodity price performance year to date. Gold's obviously had a flyer. The base metals are here. Uranium, when COVID hit, that was all COVID. That's a spot market, so it's a speculator's market, so a couple of mines closed. And then it just drifted away because the catalyst had disappeared. And basically, this is just what we call carry trade. This is just trade between traders, so it's drifted off a bit, but still at 22%. And just because I love sticking boots in, that's lithium. So if we have nuclear reactors, we don't need batteries, I'm afraid. So thanks very much. Why Vimy? We're the most advanced uranium project, largest advanced project in Western Australia. We are ahead of the curve with our team and our uranium sales in a first world jurisdiction, and I can't underline enough that a first world jurisdiction is really important to the US utilities. And as I said earlier, consumption in 2020 is at 180 million pounds, and mining is at 120. So there is a shortage coming. And I have to read this, I'm afraid. The lawyer said I had to read it. So do you mind if I... No, I'm
We've
kidding.
got afternoon tea, but you can read it. It's okay.